Picture this. You are standing at a checkout screen at 11:47 p.m. You have got a $180 pair of sneakers in your cart. You have also got $23 in your bank account. And right there, between the Pay Now button and the quiet voice in your head telling you to close the tab, is a third option. Small, green, friendly, pay in 4, 0 interest, no fees. You click it. Of course you do. And here is the part nobody tells you about that click. That single moment, repeated by 380 million people across the world last year, has quietly become one of the most sophisticated debt traps ever designed. Not by accident, by architecture. This is the buy now, pay later story, and most of it is still hidden in plain sight. Let us start with the pitch, because the pitch is genuinely brilliant. Buy now, pay later, or BNPL as the industry calls it, is sold to you as a smarter way to shop. Split your purchase into 4 equal payments. No credit check, no interest, no drama. Companies like Klarna, Afterpay, Affirm, and Sezzle built entire empires on that 3-word promise. And they grew fast, obscenely fast. Between 2019 and 2022, global BNPL transaction volumes grew by over 1,000%. Not a typo. 1,000%. Klarna, a Swedish company founded in 2005, became Europe's most valuable private fintech startup. Afterpay was acquired by Jack Dorsey's Block for $29 billion. Affirm went public and briefly hit a market cap near $47 billion. The investors loved it. The merchants loved it. And consumers, especially younger ones, absolutely loved it. But here is where the story gets interesting. Let us talk about who actually pays for free. When you use a BNPL service and pay 0 interest, someone still has to make money. That is just physics. Money does not evaporate. So where does it go? The merchant pays. Every time you split a purchase into 4, the retailer typically hands over between 2 and 8% of the transaction value to the BNPL company. That is significantly higher than what a credit card charges. Visa and MasterCard usually take around 1.5 to 3%. BNPL companies take double or sometimes triple that. So why would any merchant agree to that? Because BNPL does something remarkable for merchants. It makes you spend more, a lot more. Studies consistently show that cart sizes increase by 30 to 50% when BNPL is offered at checkout. The psychological mechanism is almost embarrassingly simple. When the price is broken into small numbers, the brain does not process it the same way. A $200 jacket becomes $50, and $50 does not feel like a decision that needs a week of deliberation. This is not a theory. This is the entire business model. BNPL companies literally market themselves to retailers by saying, "We increase your average order value." They are not selling you a payment method. They are selling your merchant an impulse trigger. And you are the product being triggered. Now let us get into the math that nobody wants to show you. Here is a scenario. Not hypothetical, composite, but realistic. A 24-year-old woman, let us call her Maya, uses BNPL 4 times in a single month. A clothing purchase, a home goods order, a skincare bundle, headphones she needed for work. Each one felt reasonable. Each one was split into 4 payments. Each payment looked small on its own. But here is what Maya's spreadsheet actually looks like. She now has 16 upcoming payments spread across 4 different apps, for different billing cycles and 4 different due dates. Some pull from her debit card. One links to her credit card. The total outstanding balance? $620. The monthly cash flow obligation? Nearly $200 stretched across weeks that don't align with her paycheck. The payments start missing. Not because Maya is irresponsible. Because the architecture was never designed for her to win. It was designed for volume. And when she misses a payment, the tone changes fast. Late fees kick in. Some companies cap them. Some do not. Klarna charges late fees in several markets. Afterpay charges them. In Australia, where BNPL adoption is among the highest in the world, a government review found that 1 in 5 users had missed a payment. In the United States, a Consumer Financial Protection Bureau survey found that BNPL users were more likely to carry other high-interest debt, more likely to be financially stressed, and less likely to understand the total cost of what they had agreed to. That last part. Read it again. Less likely to understand the total cost of what they had agreed to. Here is the really uncomfortable layer underneath all of this. BNPL companies, for most of their existence, operated almost entirely outside the regulatory frameworks built for credit. In most countries, if a bank gives you a loan, there are rules. Affordability checks, disclosure requirements, cooling off periods, credit bureau reporting, a whole architecture of consumer protection built up over decades because, historically, debt has a way of eating people alive without guardrails. BNPL bypassed nearly all of it because BNPL was technically not a loan. It was a deferred payment arrangement, a legal category that sat in a comfortable gray zone. No formal credit checks required in most jurisdictions. No mandatory reporting to credit bureaus. No standardized disclosure of what happens when you miss a payment. This means two things happen simultaneously. First, people who would never have qualified for a credit card started accessing credit-like products with none of the protections that come with credit cards. Second, because BNPL debt was invisible to credit bureaus, people could stack multiple BNPL obligations without any lender knowing. No single institution had the full picture. Not the banks, not the regulators, not even the consumers themselves. The industry called this financial inclusion. Critics called it something else. The cracks started showing around 2022. Interest rates rose globally. The easy money era that had funded BNPL expansion at nearly any cost started drying up. Klarna, which had been valued at $46 billion in 2021, raised money the following year at a valuation of $6.7 billion. That is an 85% collapse in 12 months. Affirm stock fell over 80% from its peak. Afterpay's parent company Block wrote down the value of its acquisition significantly. The venture capitalists who had championed BNPL as the future of finance got very quiet very quickly. But here is the irony. While the companies bled, the products did not disappear. They doubled down. Apple launched Apple Pay later. PayPal expanded its own version. Amazon integrated BNPL at checkout. The major banks, who had initially watched from a distance, started launching their own versions, afraid of being left behind. BNPL did not die. It metastasized. Let us zoom out now, because this story is not really about sneakers and skincare. What Buy Now Pay Later represents is something much larger. It is the latest chapter in a very old story about how consumer spending is engineered. Credit cards in the 1970s rewired how Americans related to money. Subprime mortgages in the 2000s almost broke the global economy. Each time, the product was framed as liberation, access, freedom. Each time, the fine print told a different story. BNPL's specific innovation is psychological precision. It does not trap you with a high interest rate you can calculate. It traps you with invisibility, small numbers, scattered due dates, an interface designed to feel as low stakes as choosing a delivery window. The regulators are now catching up, slowly. The UK has moved toward formal BNPL regulation. Australia has tightened its framework. The CFPB in the United States has issued guidance treating BNPL more like traditional credit. The gray zone is shrinking, but the behavior is already baked in. Hundreds of millions of people have been trained to see split payments as the normal, responsible way to buy things. And the companies have quietly shifted their language from zero interest to flexible payments, already preparing for a world where scrutiny increases. The product evolves. The mechanism stays the same. Here is what to actually take away from this, and it is not what you expect. BNPL is not evil. It is not a conspiracy. It is a business model that is extraordinarily good at what it does. The people running these companies are smart. The product design is sophisticated. And in certain circumstances, used with discipline and full awareness, it can be a neutral tool. The problem is that it was never designed for discipline. It was designed for the opposite. Every friction that would make you pause, compare, and reconsider was deliberately removed. Because your pause is their loss. The question worth sitting with is not whether BNPL is good or bad. The question is this. In a world where every checkout screen, every app, every financial product is designed by teams of behavioral economists and UX researchers whose literal job is to reduce your resistance to spending, whose side are you actually on when you click? And more uncomfortably, how would you even know?